In this section, I will go over the duties and responsibilities of those charged with governance. Corporate governance is defined as the system or process by which companies are directed and controlled. It is based on the principle that companies are accountable for their actions, and therefore broad-based systems of accountability need to be built into the governance structures of companies. Corporate governance has an external and internal source. External sources are laws and mandatory and voluntary codes that are set outside the organization to follow. Internal corporate governance is how these laws and codes are complied with and integrated into the culture and values of the organization, showing how governance is implemented and works in practice. Do you know of any companies that list their values but do not follow these? That is a failing in the internal governance. In this section, we are mainly looking at internal corporate governance. It is the director's responsibility to implement and maintain good corporate governance standards within a company, not just by acknowledging and listing the regulations that the company should follow, but by actively putting systems in place and by investigating and disciplining staff who don't comply. They must do this to ensure the company is adequately managed to protect the shareholders' interests. The shareholders own the company but appoint the directors to manage the company for them. Unfortunately, there are no shortage of examples of corporate scandals where directors have acted in their own interests and not of the shareholders. Over the years, there have been many codes and standards that were issued. These were combined into the Combined Code of Corporate Governance. All listed companies must report their compliance with this code in the financial statements. Corporate governance, as you can see, is something that must be implemented throughout the entire organization. However, I am going to discuss it in the context of preparing the financial statements. Good corporate governance must be followed when preparing the financial statements. The annual financial statements are the main communication between the board of directors and the shareholders and must give the shareholders a clear picture of the company. For assurance over the company and the financial statements, the shareholders may have the company audited annually, if not already obliged to do so by law. The financial statements must be prepared so they give a true and fair view of the company's position. This means using consistent and suitable accounting policies to reflect this. The requirement to produce financial statements that are true and fair is so important that it is usually included in companies' legislation. Systems must be implemented to ensure that the financial statements reflect this. All the principal risks facing the business must be assessed, and you must show what actions are being taken to reduce them. All important issues must be disclosed in the accounts. If not in the main body, then they must be included in the notes. The financial statement should assess the ability of the company to continue to exist, its ability to meet its liabilities, taking into account its current position and the risk the company faces. The financial statements must also state if they are prepared on the going concern basis, which is that they are prepared on the assumption that the company will continue into the future. The director's role is to define the purpose of the company, to define the values by which the company will perform its daily duties, to identify the stakeholders relevant to the company, to develop a strategy combining these factors, to ensure implementation of this strategy. As you can see, their role is extremely important, and they have many duties and responsibilities, such as complying with the company's constitution, to act in the employee's best interests, to act in a way that is most likely to promote the success of a company, to exercise reasonable care, skill, and due diligence, to exercise their own independent judgment, to declare any personal interests in transactions, and to avoid conflicts of interest. This is not an exhaustive list of directors' duties. However, I want to look specifically at the duties and responsibilities of directors when preparing the financial statements which you see on this slide. The directors are responsible for keeping proper accounting records, Preparing financial statements for each individual financial year in accordance with the applicable financial reporting framework. Ensuring financial statements fairly present the activities of the business. Establishing and maintaining a system of internal controls that ensure the financial statements are free from material error. These systems should also prevent and detect error and fraud. The directors are also responsible for filing the company's financial statements and other returns with the relevant authorities, such as the tax collectors, on a timely basis. As I said before, auditors may come in to test the financial statements to ensure they are correct on the shareholders' behalf. When they finish this process, called an audit, they will give an opinion to the shareholders whether the statements are compliant with the financial reporting framework and if they give a true and fair view of the financial statements. The auditor must be independent, so they must work independently of the directors and shareholders. They must be objective, so have no personal interests in the outcome of the audit. And they must act with integrity. This means being honest and truthful and deal with all parties fairly. If anything affects an auditor from being independent, objective, or from acting with integrity, it is the auditor's duty and responsibility to take steps to avoid such conflicts, even to go as far as to refuse the engagement and making the shareholders aware of their reasons. Auditors are external to the company. However, an audit committee may be formed in the company. The committee should be made up of independent, non-executive directors, with at least one individual having expertise in financial management. They are responsible for oversight of internal controls, approval of financial statements and other significant documents prior to agreement by the board, liaising with external auditors, high level of the compliance matters, and reporting to the shareholders. Sometimes the committee may carry out investigations and deal with issues reported by whistleblowers. Not every company will have a specific audit committee. In these cases, the responsibilities lie with the board of directors.